Hi, this is KMOT. This podcast is brought to you by Majuba TVET College, and it specifically relates to income tax N6 for South African TVET colleges. In this presentation, I'm going to tackle question 6.2 of the November 2016 previous question paper. I'm going to make reference to SAICA Student Handbook, and I'm specifically going to look at the South Income Tax Act for South Africa, the South African Income Tax Act. I'm hoping that at the end of the presentation, students will achieve the following subject outcomes and learning outcomes. Students will be able to determine the tax consequences of lease improvement, and they'll also be able to calculate allowances relating to the lease improvement. I'd like to take you to question 6, and as I've mentioned, I want us to focus on question 6.2. Just quickly, we're required to determine tax implications for CFW construction. Let's quickly go to 6.2. In 6.2, we're told that CF construction entered into an agreement with Seedwell for the lease of land for 15 years from the 1st of September 2013, and they agreed that CFW construction would erect an administration building on land at a cost of 2.5 million. A building commenced on the 1st of February 2014, and it was completed and brought into use on the 1st of February 2015 at a cost of 3 million. I'd like to bring to your attention the fact that the two amounts are capital in nature, as they were incurred in respect of erecting an administration building. Therefore, we couldn't have employed the provisions of section 11A to deduct an expenditure of 2.5 million or an expenditure of 3 million. Therefore, we need to assess whether, in terms of the South African Income Tax Act, whether there are any allowances that specifically address this type of an expenditure. This capital expenditure is referred to as a lease improvement, as it arises from lease. It's a lease improvement because CFW is not the owner of land. However, he has agreed through a lease contract that he will erect a building on a land that is owned by Seedwell. Therefore, this is referred to as a lease improvement. In terms of section 11G, a taxpayer, CFW, might be granted an allowance on lease improvement. I'd like to take you to the slide just quickly so that we can go through the basic principles relating to lease improvement. It is lease improvement. It relates to an allowance in respect of an expenditure. Remember, we have an expenditure of 3 million. Even though the CF agreed on 2.5 million, the actual expenditure incurred was 3 million. So it says expenditure actually incurred. It is actually incurred because CFW has actually erected an administration building, and he has actually completed the building on the 1st of February 2015. In pursuance of an obligation, of course, the obligation was brought about by the lease agreement. Remember, there was a lease agreement, and in the lease agreement, CFW undertook to erect an administration building. So that could be in pursuance of an obligation to effect improvements on the buildings. Of course, the land didn't have any building before the lease, but however, due to the lease agreement, CFW was going to erect an administration building. So that component has been complied with, and the last component refers to incurred under the lease agreement. Of course, we've already mentioned that there's a lease agreement between CFW and Seedwell. Okay, so what would be the tax implications? Before I even go to the calculation slide, in terms of section 11G, as I've already mentioned, in terms of section 11G, CFW will be, as he incurred the expenditure of 3 million, will be granted an allowance on the expenditure. However, he will be granted an allowance on the amount agreed upon, which is 2.5 million. I'd like to emphasize the fact that CF incurred an amount of 3 million, but however, on the lease agreement, the agreed upon amount was 2.5 million. Therefore, the lease improvement allowance granted in terms of section 11G will be limited to the amount of 2.5 million. So moving along swiftly, the next thing I'd like to do calculations. Okay, let's go to the calculation slide to save time. So I'm going to do the calculations. So before we even do the calculations, I'd like to bring to your attention the fact that we're going to take that amount, as I've already explained, and we're going to divide it by the lesser of the following. So we're going to divide the lease improvement. That's the lease improvement. It refers to that amount. We're going to divide it by the lesser of. Remember, this is the principle that is embedded in section 11G. It comes with section 11G. So we're going to divide the lease improvement by the lesser of. Okay, let's actually determine the lesser of. So we're going to take the lease period in months. So it's important that you convert the lease period in months. Let's go and establish what the lease period was. The lease period was 15 years. It is clearly 15 years. So please follow. It is clearly 15 years. However, we have to convert it to months. How do we do the conversion? We simply multiply by 12 months. The reason we have to do that conversion is because we want to deduct the months from the commencement of the lease period until the building was completed. Please, we're not going to use that date. That date is always provided. That date refers to the building, commencement of the building, when they started erecting the building. But we never actually use that date when we do our calculations of months. So we're going to use that date. That date is referred to as the lease agreement, the date of the lease agreement. And we're going to deduct we're going to take that period from the 1st of September 2013 and until the 1st of February 2015. That is when the building was completed. We're going to take those months and we're going to reduce our initial 15 years. Remember, for us to do that, we need to convert it into months. So that's the conversion. We've done the conversion. It's straight and simple. The next thing that we're going to do, as I've already explained, we need to less the period from the commencement of the lease. I've already indicated that it will be from the 1st of September 2013 to the 1st of February 2015. That's the completion date. So we need to determine the months from there to there, and we need to deduct them. I've already determined those months as 18 months. I want to take you to the calculation of months because I know this. Most students actually battle with the calculation of the 18 months. I'm going to quickly take you there. There you are. So this is how I recommend you do the calculation if you battle. If you do not battle, just adopt your own methods. But if you battle, this is what I recommend. Remember, the 1st of September is the commencement of the lease agreement. So let's employ the calendar year. You know that the calendar year commences on the 1st of January and it ends in December. So in calculating this month, let's just employ the calendar year. So we're going to say in 2013, we couldn't have started in January because the lease only commenced on the 1st of September. So from the 1st of September 2013, let me quickly get the laser. There you go. So from the 1st of September 2013, commencement of the lease, until December 2013, we had 5 months. So we had lost 5 months before we can take it, we can bring the building into use. And then we're going to continue and say from the 1st of January 2014 until December for the entire 2014. That is if you're using the calendar month. For the entire 2014, we lost 12 months because the building has not yet been completed. So we came up with 12 months. And from the 1st of January 2015, remember, we were specifically told that the building was completed on the 1st of February 2015. So from the 1st of January 2015 to the 1st of January, February 2015 came to 1 month. So we're going to add all those, and the total of those months is 18 months. And we're going to, let me quickly go back to that slide. So we essentially going to take, remember that was the initial period, and we're going to less the period from the commencement. That's the basic principle. If my calculations are confusing, just remember that the purpose of this exercise is to determine the lease period from commencement, is to less the lease period from the commencement date until the date of completion. If you're able to determine that, That's it. It's 18 months in months. And we're going to deduct it from 180. That's the initial lease period in months. We're going to get 162. So essentially what we're going to do, as a rule of thumb, we're going to take the 162 and we're going to divide, we're going to take the 2.5 million. Let me quickly go to the question. So we're going to take the 2.5 million and we're going to divide it by 162. That's how we determine the capital allowance. If you like, you can compare the capital allowance to depreciation. You know how we do depreciation in accounting. We're given rates and we take those rates and we multiply them to the cost of whatever asset that has been acquired. In this case, we divide in order to determine the capital allowance, which you can actually refer to as depreciation. But I'd like you to use the word capital allowance. So we're essentially going to take that amount and then we're going to divide by 162. But I need to emphasize that we actually divide by the lesser of. Let me quickly get a laser once more again. I want to emphasize that we divide by the lesser of the 162 or we have the limitation that is embedded in section 11G, and the limitation says that those months shouldn't exceed 300 months. How did you obtain 300 months? The provisions of the Act specifically says the years that you're going to use, they shouldn't exceed 25 years. So if you want to get an equivalent of 25 years in months, you're simply going to take 25 multiply by 12. Therefore, we shouldn't use months more than 300 months. To cut the story short, you're going to take the lesser of the two. What is the lesser of the two? The lesser of the two is 162. And that's how you calculate the two periods. This period it's given, it's 25 years. It's stated there's nothing we can do about it, please, guys. There's nothing we can do about it. It's given in the provision, we have to use 25. It's not a choice. We're not thumb sucking. We're specifically told by the receiver to use 25%. However, we do not always use 162. We have to do calculations as per the given question. And we're going to compare the two. The lesser of the two, it's 162. Now let's go do calculations. I'm going to go to the calculation spreadsheet. Let me go to the calculation spreadsheet quickly. I'm going to go to the calculation spreadsheet. There you go. There you go. Apologies. It takes a while sometimes. I don't know why it happens. There you go. Remember, we're going to call it lease improvement. Lease improvement. Lease improvement, that's its name, that's its proper name. Please get used to the names. It's done by section 11G. Even if you do not write sections, don't worry, you don't lose marks. But let's do calculations. Firstly, as I've mentioned, I'm not going to waste your time and do calculations relating to months. I've already determined the months. Let's quickly go to the presentation slide. Remember, we're going to use 162. I recommend that you take the examiner through the calculation so that you can obtain marks where you get wrong. So I'm going to use the 162. I'm going to use 162. So essentially, I'm going to say this would have been limited to the greater of. I know it's confusing. I'm going to say the greater of. I know it's confusing. Number one, the first one would have been lease improvement divide by, I'm just going to say lease period, but we know there are adjustments that we need to factor in. Number two, I'm going to say lease improvement divide by 25 years. So we're going to take the lesser of the two. Please follow me. I'm going to do calculations there. I'm going to take the final amount in the final column. So allow me to do calculations relating to the first one. I'm going to say, remember, it's limited to 2.5. Let me quickly go show you once more again. We're going to take that amount because it's the amount that they agreed upon. Even though CF incurred the actual amount of 3 million, we're going to limit it to 2.5. Let's go limit it to 2.5. There you go. 2.5 million. We're going to divide that by 162. Remember, I already did the calculation. We're going to divide that by 162. We're going to multiply by months of usage in the current year of assessment. Our current year of assessment is 28 February 2015. It was completed and brought into use on the 1st of February 2015. So essentially it was only we're only going to take 1 month in the year of assessment. We're only going to take 1 month in that respective year of assessment. So I'm essentially going to multiply by 1. There you go. Please do your calculations, because if you go, we want to get to February 2015, and we only used the building from the 1st of February 2015. That's how we got to that 1 month. Moving along swiftly, we would have taken the amount of 2.5 million. Remember, I already did calculations. Divide by, we're going to divide by, I'm going to quickly go to the presentation. We're going to divide by 300 years. I'm going to divide by 300 years. I'm going to divide that by 300 months. 300 months, apologies, not years. 300 months, I'm going to multiply by 1 month. We're going to compare the two, and we're going to take the greater of the two. We're going to compare the two, and we're going to take the greater of the two. Let me quickly just format so that you can actually see that amount properly. There you go. So we've got an amount of 15,432, and we've got an amount of 8,333. We're going to take the greater of the two as a permissible allowance in terms of section 11G for CF. So we're going to take that amount. I'm going to say equals to, that's the amount that I'm going to take. There you go. There you go. Let's quickly go to the next amount. So now, as you can see, CFW actually incurred 3 million. She incurred 3 million. However, he was already granted an allowance on the expenditure of 2.5 million as per the lease agreement. However, he incurred the 3 million. So there's a difference between the two amounts that he wasn't provided any allowance on. So we're going to take the difference between the two, and we're going to allow him a deduction in terms of section 13 queen. Section 13 queen. Before I even do the calculations, I quickly want to take you to the presentation slide. That's section 13 queen. Section 13 queen, it's an allowance in respect of buildings used by the taxpayer for the purpose of producing income in the course of taxpayer's trade, and a taxpayer will be allowed 5% on the cost of the building. This requirements addresses that amount because CFW uses the building for the purpose of producing income. So therefore, we're going to allow him 5% on the difference between that amount and that amount. Please, I'd like to explain. The receiver cannot permit you to deduct that amount for the second time. So essentially what I'm saying is, all the time when you're dealing with deductions and allowances, you can only get a taxpayer is only entitled to one allowance. So a taxpayer cannot be granted more than one allowance, cannot have a duplication of an allowance. So if we were to take section 13 on that amount, it will be a duplication. So therefore, for us not to duplicate, we're simply going to take the 3 million, that is the actual amount, and deduct the amount that has already been taken into account in terms of section 11G. The difference between the two will be granted a 13 queen allowance, which relates to commercial buildings. Let me quickly go do calculations. So I'm going to say this is an allowance on buildings. I'm not sure, I guess any wording. And this is done by section 13 queen. I'm going to do the calculation there. I'm going to do the calculation there, let me do the calculation. We're going to say equals to, remember we're going to take, it's on 3 million, but of the 3 million, the 2.5 has already been taken into account in terms of section 11G, and we're going to multiply that by 5%. It's not apportioned. It's not apportioned. You'll realize that section 11G, we did apportion that amount, but in terms of section 13, Queen, we do not apportion this amount. What this means is, even if the building was used for 1 month in the current year of assessment, the taxpayer will receive the full allowance. This allowance is never apportioned. There you go. So if you wanted to see the calculation, let me quickly do it there. We took 3 million. We deducted the amount of 2.5 million. And we multiply that by 5% to get to that amount of 25,000. So deductions relating to 6.2 specifically will come to a total of, okay, let me just make sure that that total is correct. Sum of, yes, will come to a total of 40432. So these are the allowances that will be taken into account in determining CF's taxable income. And how are they going to be taken into account? They'll be deductible from the income of CF. I hope you guys understood. Thank you.